Welcome. I am Paul Hedgie, CEO of the County Medical Society, and want to thank you for joining us again in our series of webinars. This one put on by our partners at Bank of America Private Bank. This is the first in a two-part series, Financial Wellness for Physicians. This was a topic requested by your physician leadership as we were planning out programming for this summer and fall. Something we thought particularly started with physicians newer in practice and those coming in, but really I think will be helpful to all physicians and all of our members. Participants should be able to be better organized and educated with respect to their financial life, master better understanding of how to save, invest, and protect your earned income and accumulated wealth, learn to develop your own lifestyle, legacy, and philanthropic goals, and provide in-depth discussion on savings, investing, financial trust, and navigating income taxes. The next in this specific series is going to be September 14th. And then following that up, we will have a top 5 risks for your practice webinar on the 28th, done in conjunction with the Doctors Company. With that, I want to introduce our 2 guest speakers. Eric Baggett is, where did I have these? Down here. With me one second. Is Senior Vice President and Wealth Strategy Advisor at Bank of America Private Bank. He is going to be following Dirk Harris, who will kick us off. It's also Senior Vice President and Private Client Advisor at Bank of America Private Bank, both based here in San Diego. So with that, I am going to kick it off to you, Dirk.
All right. Make sure I'm not on mute. Thank you, Paul, for that. And yeah, as Paul said, my name is Dirk Harris. I am a private client advisor with Bank of America's Private Bank, and joined by my colleague, Eric Baggett, who is our Wealth Strategies Advisor. Both of us have had a career in finance. Eric has started his career in the private side and is a lawyer, as well as has his master's in tax on our team. He is our Wealth Strategies Advisor, which helps our clients with strategies and advice to better shape their goals, shape their financial lives. My role within the team is overall kind of the quarterback of our relationships and trying to understand client needs, where we need to go, how we need to, and which partners we need to bring in within the bank. We've both been doing this a while, and that's how I'll start by saying, this is every day for us. We do this day in, day out, and so if there's anything that may seem commonplace to us but isn't to you, be sure to stop, ask us a question. We'll pause after each section just to make sure there's no questions before moving on. But as well as understand that we've structured this knowing that everyone's coming from a different level of knowledge and different place. So what may seem basic to you at one point, keep listening. It may get more interesting to you. But with that, I'll kick it off. Let me see if I can share this. So should be seeing, it says part 1, saving, investing, trust basics, and income taxes. Everybody see that? Yeah, perfect. So jumping in, the disclaimers, all the legal stuff, and then kind of a agenda of where we're going. Saving, we'll cover investing, trust basics, and income taxes. So jumping right in. I think it's throughout my career what I've noticed. We really have 2 types of clients, and I'll make it very simple to say there's either savers or there's spenders. Some people I've noticed throughout my career, it's very easy for them to save, and some people it's not. Some people spend more and they have trouble saving. And I think the earlier in your career, the earlier you figure out whether you're a saver or a spender, the easier it is to save and invest and long-term financially secure. Because if you are a spender, then you need to protect yourself from that, and we'll talk about some of that and how to do that. But I think that's really it in a nutshell. If understanding where you're at, who you are, and being honest and open with that. It doesn't, if you're a spender, it doesn't mean that you can't save. It's just there's things you can do around that to save, make better habits. And I think so. Starting always with a budget is helpful, especially. Or depending on where you're at in your career, especially early career, understanding where your income sources are, what those income sources are, and understanding where your expenses are, and tracking that, looking through that. This doesn't have to be complicated. It doesn't have to be in any way, shape, or form, even as detailed as this page suggests. This template suggests. You may put all of your monthly expenses, you may put everything on a credit card each month and pay it off, and you have $15,000 a month coming into your account, and you have $8,000 that goes on your credit card each and every month, and you don't know where it goes, but you know that your credit card average is $8,000. That might be a budget enough for you. That might be enough of a plan for you. Some people want to get more nuanced and more detailed and understand better where their expenses go and where their money is spent. And that's where, these budget templates come in. We have these, we can provide them to you. You can find them online, find what works for you. And I think throughout all of this, that's what I'll continue to reiterate is find what works for you, and then go from there. Once you list all that out, it's helpful to have some guidelines around what should you be spending. I think this is a common question with people that are budgeting is, well, how much should I be saving? How much should I be spending on housing? I think this should be viewed as guidelines. These are some recommended percentages that we put in place. You can find them online. They're all going to be, somewhat similar. But again, housing in San Diego may be more than 35% of your budget, especially early in your career. And early in your career, if you're working 100 hours a week and all you're doing is wearing medical scrubs, your clothing budget might not be 5% of your income. So that is this kind of needs to be adjusted. Some of these ranges here, or you kind of figure out where you need to be. I'll come back to debts because I think that one's important and that has a lot more components to it. But this is where it starts. There's a reason why we say pay yourself first and why savings is listed here first. Because if you do all these other things first, oftentimes you lose sight of, and the savings aren't there at the end because you spent it somewhere else. So once you have that, I think it becomes important to track that and track your income and expenses. There's software that can do this for you and help you with this. Quicken, Mint is one. Mint online is one. Quicken is another. The Bank of America has its own budget tool that's right there within the app. The next slide has an example of that. But again, it comes down to doing what works best for you. I've had engineer clients that track this on an Excel spreadsheet. Whatever works, it just comes down to tracking it, having a budget, having a plan, sticking to it, and then saving. As mentioned, here's a illustration. It shows a sample of the Bank of America budgeting spending tool. But that brings us to the next piece, and that's investing. So you set up your budget. You have some funds starting to accumulate. You have some savings, and I think, what do you do with it? That's the question. Okay, now I have this budget. I have this savings. I'm saving money. What do I do with it? Well, we often see, and you may have heard, set aside 3 months normal living expenses for an emergency fund. Why 3 months? Well, some people say 3 months, 6 months. As the genesis of this, from my understanding, was always 3 months because if you lose your job, it might take 3 months to find a new one. I don't know that that's the case for physicians. I don't know that you'll ever have to worry about income. I'm not a physician. I don't know what your worry is for job prospects, but I think that's where that number kind of resides. Is if you're married, maybe 3 months. If you're single, maybe 6 months. Or it's just a number. And again, it's a comfort level that you need to have. I think you have these savings that is truly that, an emergency fund. It should be liquid. It should be, we'll talk about what is liquid mean. We'll talk about where an emergency fund should be invested, if it's invested at all, or where you should park that. After you have that emergency fund, paying off credit card debt, always highly advisable, only because exactly what it says here, earning 3 to 4% on your investments doesn't come close to the 18% you might be paying in credit card debt. What about other debt? Student debt, I think, is one that is applicable to physicians coming out of school. Average, I think the last number I saw in 2018, $200,000 average medical school debt that physicians come out of school with. And I think that is a where is your interest rate on that? If you can earn more by investing $100 than you can by paying 3-4% interest on student debt, I would say invest that money and just pay off the debt over time. But again, that comes with your own comfort level. If you're a person that just doesn't like debt for any reason hanging over your head, then get more aggressive with the debt payment prior to investing that money. So it comes down individual, where you're at, who you are, what makes you happy, and what causes you stress. The next on this list is savings for a down payment for a major expense, large home or home purchase, large purchase. And that's individual. If that's something, one of your goals is to save for a large purchase, then certainly that's where you're going to want to fund that money. Other things that may be college tuition for a child, but that's putting money aside for those expenses. This make it easy on yourself. I think that's a good reminder. Going back to slide 1, spender versus saver. For a spender, you have to make it easy on yourself. You can set up, you can direct, most people today can direct deposit. You can direct your direct deposit into multiple accounts. Have X amount per month directed directly into your investment account or directly into your savings account, to where it never touches your checking account. So making it easy on yourself. And then making those regular deposits into your investment account, you can set up automatic purchases as well into investments, whether that be stocks or mutual funds or exchange traded funds. But what we call dollar cost averaging, you never really worried about where the market is, because you're buying in whatever level it is each and every month on those automatic purchases. And so there's two powerful forces in investing that you should be aware of. I think everyone on this webinar today is probably aware of the first one. This is something that's been in this slideshow for a long time. That for a long time we haven't really felt the effects of inflation, but now we are. Now we are every day. I don't think I need to describe or go into detail what inflation feels like. We're all feeling that. Compounding, it's very simply, you leave your money invested. The earnings on that money earn more money over time. Inflation, again, just going into more detail. We know that if you try to buy something that cost $100 at the beginning of this year might be $105 today. I think if you've been to a restaurant lately and compare that to what it cost to go to a restaurant last year, I think you understand inflation well. Things are cost more today. Over time, that really compounds to much, as this example shows, $100 today buying 55% of what it can in 20 years from now, only buying 55% what it can buy today. That's significant. What do you do to combat the effects of that? And I think number one, diversify your investments. Inflation is, and which investments you put it in, because some investments have higher risk of inflation. So investments that overall tend to achieve a higher return, outpace inflation, stocks, bonds, real estate. So those asset classes that have longer term, higher returns, so you can earn. Treasury inflation protected securities is always one that's recommended. I think the verdict is still out on those. Sometimes it wouldn't be my top choice. It's in this slide deck, but it's one way, very safe way to protect from inflation. But it's for the last 10 years, it's been kind of no return there, and so you could have grown your assets in other places much better, and then save more. It's important to recognize if you're saving $1,000 today, and there's 3% inflation, you need to save $1,030 next year to have the same amount of purchasing power in that. So. And compounding, very simply, if you have $100 that earns 10% this year, you have $110 at the end of the year. Simple interest, that $110 next year, that $100 is going to grow to $120. You have the $10 from year one and the $10 from year two, and there's no compounding effect on it. With compounding, that $10 you earn this year will compound to another dollar. That $10 earns 10% as well next year, and so you have $121 next year. So over time, that effect, the effect of compounding can be significant. And so here's graphically illustrated benefits of compounding and the importance of starting saving early. We see a lot of times people waiting until they say, I don't make enough money today to save, and you can see the effects of that. If you wait until you're making more money, then you have to save a lot more money to get to the same place. And so this is graphically represented. I think it's clear enough to see what happens over time with these investments. Start early, start saving early, be diligent about it, and continue is the key. So then it becomes return on investment, and return on investment has multiple components. And so when you look at your portfolio, you're generally seeing the total return. Your $100 grew to $110, or in this case, your $100 grew to $122, and that was composed of a yield. And with stocks, that yield is in the form of dividends. With a bond, that yield is in the form of interest payments. But in this example, you receive a $2 dividend on a $100 stock. That's a 2% yield on that stock. And if that same stock were to increase to $20 in a year, that's 20% appreciation. And so your total return is the 20% appreciation, the capital gain of that stock, plus the 2% dividend yield. And so you have that 22% total return. If you don't sell the stock, you don't owe taxes on the appreciation, or you don't owe taxes until you sell the stock. But the $2 of dividends you do have to pay tax on. Thankfully, there's assuming it's a qualified dividend, you pay a lower rate, 15% or 20% if you high enough income earner, but a 15% tax on that $2 investment. So taxes reduce your income, assuming it's a taxable account. Reduce that return a little bit, but multiple components of your return on investment. And then there's obviously multiple risk. Go down the list. Business risk. How is the company that issued the stock managed? Is it going to stay in business? Think of business risk. It could be strategic in nature. I always think of Eastman Kodak's decision not to go into digital when they had the opportunity. That was a business risk. That was a strategic miss for them. Financial risk, the one that always comes to mind, you buy the next Enron. The company leaders are doing things that aren't good for the company. Purchasing power risk applies more to the effect inflation will have on your investment. So if the bond that you buy is returning 4% and inflation is 8%, then you're at the end of at the maturity of that bond, you're not going to be able to purchase as much as because you didn't keep up with inflation. Interest rate risk is very simply what impact will changing interest rates have on your investments. If you're trying to refinance a debt, that's an interest rate risk. If interest rates are rising, if you have a bond that interest, you bought it a 30-year bond in 1981, and it was paying you 18% a year for 30 years. And then you had to refinance that or buy another bond, similar bond, in 2001 or 2011, I guess. What was the interest rate then? Well, it was not 18%. That's interest rate risk. Market risk, things, systematic risk of the market, things we can't control. The market goes up and down for any variety of reasons. You've heard them, you've known them, you've seen them, you've probably felt them in your portfolio. And then default risk, is the company going to be there? In this case, the bonds that you bought, will the company go bankrupt? The stock that you bought, will the company go bankrupt? The risk of default is one of the risks. And again, it comes back to how do you address these in your portfolio? Diversification. Continue to see that recommendation over and over. And so how do you diversify? Diversification, very simple. You don't put all your eggs in one basket. You've heard it before. Multiple types of investments. You spread the risk around. So this is, we're going to go into each of these 4 broad categories: cash, fixed income, equities, alternatives. But within each of these, there's also more ways of diversifying within them, sectors and time horizon, et cetera. But each of these responds differently, and we call it correlation. Each of these are correlated differently, or maybe they're not correlated. And when one zigs, the other zags, and that's in part why we own them, why we recommend diversification. And then within that, this talks about what type of risk taker you are. We'll come back to that here shortly. But the first class, cash and cash equivalents. Cash is the money you have in the bank. Currency, coins, bank balances. Typically, don't pay a whole lot of interest in cash, if any at all. We're starting to see that come back up with interest rates rising. That is a benefit. That cash is a place, again, where you can earn a little bit of return, and so that's a benefit of higher interest rates. But oftentimes, as the bold statement right at the top says, the main risk is the loss of purchasing power. If you're even earning the 2% that a 30-day Treasury yield or Treasury bond bill can offer today, it's not keeping up with the 8% of inflation. So you're losing purchasing power, even though you're earning some more than zero that we used to at the beginning of the year. Cash equivalents. So when I said earlier, this is the cash equivalents probably where you want to keep that emergency fund, something like a Treasury bill, something like a money market fund, where you're being paid a little bit, but you're not taking a whole lot of risk. A Treasury bill is considered a risk-free asset. You may remember from finance classes the risk-free asset, the 90-day Treasury bill. Money market funds, very similar. They're required, I guess, to keep that NAV at $1. You put $1 in, you should be getting $1 out. Certificates of deposit, little less liquid. I wouldn't recommend CDs if you're thinking that there's a chance you might need the money. You'd have to break the CD, or if it's a brokered CD, sell the CD, and those aren't very liquid. So you typically have to hold them to maturity. Money substitutes. This talks about cashier's checks or certified checks, traveler's checks. We still offer traveler's checks. I think I can't remember the last time we've helped a client get traveler's checks, but I think Apple Pay, credit cards, debit cards. These are what we refer to with money substitutes. Fixed income, usually we're talking about bonds, and very simply, you lend money to a company or a government in return for a periodic interest payment in return. As high income earners in the state of California, you're probably, if you're going to allocate to fixed income, probably should be thinking of municipal bonds as the where you want to be. And so, this runs through an example. This slide runs through an example of the municipal bond versus a taxable bond and what that tax equivalent yield is. In short, what municipal bonds will typically pay a lower interest rate, and that's because you're not paying taxes on that money. If it's a California municipal bond, you're not paying federal taxes or state taxes. If it's a bond from another state, you're not paying federal taxes, but you could incur California state taxes on that income. But to get to, am I better off in a municipal bond or a taxable bond? There's a very simple calculation that requires you to take your taxable income tax income bracket, marginal tax bracket, and subtract that from 1. So if you're in the 24% tax bracket or tax rate, you subtract that from 1, and you divide your yield by that 1 minus your tax rate. Gives you a tax equivalent yield. And so in this example, they're using 4% and 24% tax rate. So the tax equivalent yield is 5.26%. So what does that mean? If you're looking at two bonds, and one of them's a municipal bond paying 4%, and one of them's a corporate bond that's paying 5%, well, you're better off taking the municipal bond. If it's a corporate bond paying 5.5%, well, you're better off buying the corporate bond, paying taxes on it, and you're left with more money at the end. So that's a simple calculation. But again, coming back, primary risk for fixed income is that purchasing power risk. The interest rate risk can be as important as the purchasing power risk. Purchasing power today in a high inflationary environment, probably a bigger risk than interest rate risk in a rising rate environment where you can reinvest that money potentially at a higher rate. But that's fixed income. And then we move on to equities. So equities, stocks, you may know equities as stocks, and publicly traded stocks is what most people know. And so this is buying a piece of a company. You're a owner in a company. I think this is what is lost most when we've moved over my career, moving from paper trading to electronic trading. I think we lose sight of the fact that we actually own a company when we buy stock, and so we see people trying to time the market and buying and selling. And what I like to remind people of is, if you owned the grocery store down the road, just because a recession is coming doesn't mean you're going to go out and sell that grocery store. But the ease of doing that from our phones and from just pressing a button to sell has made us lose sight of that business ownership. But that's exactly what we have when we buy stocks. The return of stocks comes from what we talked about earlier, the yield in the form of dividends, as well as capital appreciation. And so that combined gives you your total return on stocks. Going back to the diversification, there's stocks can be it's a broad asset class. There's multiple ways of segregating or classifying stocks. Often this comes down to the size of the stocks. I think this is an easy way to both look and think about safety in the stocks, as well as efficiency. And when I talk about efficiency, how efficient is the market at pricing these stocks? So a large cap stock, what I tend to think is the market is pretty efficient. There's enough eyes on that stock. Think S&P 500. There's enough eyes on those stocks that the pricing of them, there's rarely a discrepancy in that. There's not much that's not known about that stock, and so the price is reflective of all that's known in the market. Whereas you get down to the micro cap level, the smallest of the small stocks, and you might have information, or you might know something that it may not be widely followed stock. There may not be a widely followed or sector. There may be things that are unknown, where if you bought that stock and it becomes the next Facebook, it becomes the next Uber, or that is there. But there's inherently more risk. There's less efficiency, but inherently more risk. And so as you move from micro cap to large cap, there's more safety, but that safety also comes with more efficiency. And then there's alternative investments. So alternative investments, again, is a broad category for a lot of different investments: real estate, oil and gas, farms, precious metals, commodities, hedge funds. These tend to be the least correlated investments, both between each other as well as within stocks and bonds. And so oil and gas tends to move counter-cyclical. If oil is rising, that tends to make it harder on other things, and so you might see stocks fall if oil is rising. If commodities are rising, higher inflationary environment, you might see other things falling. And so that's kind of, again, to add as a diversifier into your portfolio. Some of these things can and should be considered. But then how do you do this? Mutual funds is one way of doing this. You might say, hey, I want to invest $1,000 every month, but what stock do I buy? With Tesla trading at 900, do I buy one stock of Tesla every month, or how do I diversify if that's what I'm investing? Mutual funds can be the answer. And mutual funds refers to a large group of funds or investments. Not all stock. There's bond mutual funds. There's even alternative investment mutual funds that act as hedge funds. So there's all different types of mutual funds. And then this slide talks about loads on mutual funds, something we don't see a whole lot of anymore. Maybe if you're trying to self-direct your investments, this should be something you look at and pay attention to, the front end load or deferred back end load. Just talks about how the fees are paid in those funds. But that's the mutual funds. Think pooled investments. Think a way of achieving diversification without necessarily having to go buy 500 stocks if you're trying to buy the S&P 500. But then we bring it all together and asset allocation. What does that mean? Now you have all these different investment possibilities. You know it all. In 1990, Harry Markowitz earned the Nobel Prize for his work on modern portfolio theory, which is to say, owning two different asset classes, two different risky asset classes, is actually less risky than owning either one of them individually. And so putting this all together, you buy some stocks, you buy some bonds, you buy some alternative investments if that's in your wheelhouse, to create a portfolio that's overall lower risk than any one of those individually. Now, what I say to this is, again, this is very specific to you as the individual, and it comes to your own risk tolerance. It comes to your own time horizon. You're not going to want to put something, you're not going to want to invest money in the market that you're going to need next year, for instance, because what if next year the market's down 30% and you need that money for a down payment on a house? So asset allocation and where you're putting that money is specific to you. It's specific to your risk tolerance. Some people don't like to see the value of their portfolio go up and down. As physicians, what this talks about, the more secure your cash flow and is for meeting your current needs, and the longer you have until retirement, the more aggressive your asset allocation can be. And so you can put, when we talk about aggressiveness, stocks are more aggressive than bonds. And so you can put more of your asset allocation, more of your investment dollars to stocks than to fixed income or bonds. And so that's kind of where you can work with an advisor to do that as well.
Hey, Dirk, on that, I have two relevant questions that have come in, and I'll just ask them both and you can deal with them. The first is there an advantage to investing in mutual funds over ETFs? And then the second is, what about investing in cryptocurrency?
Both great questions, and crypto was omitted from this presentation, and I think that cryptocurrency probably deserves a place. But here's what I'll say about crypto, and I've read 6 books on crypto and blockchain, and trying to understand crypto. It's not something I understand. I think, but that doesn't mean it's a bad investment. And I used when I was running a hedge fund portfolio, I shorted Amazon, and I shorted Tesla as well, because I didn't understand the valuation. And I thought there's no way the valuation of these companies makes sense. And then I read the Everything Store, Bezos's book, and I read Elon Musk's book, and I said, you know what, the valuation of these companies, I don't understand it, but I want to bet on these two guys. They're smart guys, and I think that's how I've kind of concluded. That's my conclusion, and how I think about crypto is I've tried to understand it. I've tried really hard to understand it. I think of myself as a smart person and capable of understanding things. I don't understand crypto, blockchain, but I look at the people that are involved in crypto, some of the brilliant minds, people that I really respect, and respect their work. And I do think that crypto is worth a speculation, and I think it's something that you should think of in your portfolio if you do allocate to crypto as just that. It's a speculative. Will it be what the bullish fundamental thesis says it's going to be? I have no idea, but is it worth a couple of % of your dollars to allocate to say, what if? That's how I think about crypto. I don't know that that's the right answer. I don't know that there is a right answer. I think it's all kind of speculative at this point. And like I said, I look at more of the people involved in crypto today and think, yeah, there's some validity there from that regard. It's certainly catching on and growing. Mutual funds over ETFs, I think that, all else being equal, I think it comes down to, I look at taxes and fees, and both of those I think are better in ETFs. But ETFs tend to be more passively managed, which is quite okay. You can actively manage a passive portfolio, which is to say passive versus active. We didn't discuss that in this, but passive investments, there's this great debate, always been this great debate. You might remember the Warren Buffett betting, $10 million or whatever the bet was on which is going to win over the next 10 years, passive or active. Passive just means, you buy an index like the S&P 500 and you leave it alone. It grows over time. It does what the S&P 500 does. New participants come in. But there's no real active management to say, I'm going to pick Facebook over Google. I'm going to pick Pepsi over Coke, whatever the case might be. And so that's but you can actively manage a passive portfolio. So if you have a portfolio of ETFs that says, hey, I have this large cap ETF, a small cap ETF, a foreign fund, or foreign ETF that owns Chinese real estate, whatever the case might be, you can say I'm going to overweight U.S. equities versus that Chinese real estate fund, or so you can actively manage within the ETFs. Again, coming back, all else being equal, fees and taxes, I think, are where you should focus your energy in your portfolio, and you pay lower fees in ETFs, and you don't get capital gains distributions, which mutual funds are required to distribute 95% of their capital gains. That's to say, if they're buying and selling throughout the year, as they sell things, they're generating capital gains. It's always frustrating for people in a mutual fund at the end of the year. They go to do their taxes, especially in a down year. You get this tax bill from the distribution that the mutual fund made, and you say, "Wow, I have to pay capital gains, and my portfolio is down 10%." So that's always kind of a hard pill to swallow. There's a question on private equity. I think private equity also, again, deserves a place in the portfolio. I think it falls into that alternative bucket for us, but it's more alternative bucket because of the time horizon of it. It's also one of the things, one of the reasons I think it tends to do better than regular equities, because it's locking you into that investment. You cannot sell it even if you wanted to. In most instances, you're giving your money to some other company, some other to be either invested if you're going directly to the company, or to be managed into potential investments if given to a private equity fund. And so but think about that money as largely illiquid. You can't touch it for 10 years. In recent years, I think you put money into the stock market for 10 years, you put money into a private equity fund for 10 years, you're largely the same. Private equity funds have a lot more fees involved with them, but in years where things are highly volatile, you may long term be better off in the private equity. There's no, historically private equity has returned higher returns than the stock market itself. But a lot of that has been, I think, a result of you can't buy and sell it. You have to have these investments for over time or longer time locked up. And outlook for future of commercial real estate. Final question here. Is I think localized and specific to commercial real estate. I think it falls into, again, as many categories as equities potentially. You have industrial, you have multifamily, you have office, retail, all of these different subsectors of commercial real estate. Multifamily and industrial is incredibly hot. It's incredibly hot here locally in San Diego. Something like a hotel is not, although they're coming back. Retail, office space, I don't, I think to be determined what happens to all office space. We know people, we have clients that 30% vacancies, people aren't renewing their leases downtown. What goes on, what happens to that? I don't pretend to know, long term how that all plays out. I think that's a to be determined. Industrial, multifamily, if you're buying multifamily today, I think it's how do you make the numbers work with a 4 cap in multifamily, or if you're putting leverage on it. I think where commercial real estate makes a lot of sense is just that, going back to the old saying, it's not what you make, it's what you keep. With commercial real estate, highly levered, highly depreciated, you can make the income off of that real estate tax-free for all intents and purposes. And Eric's going to talk about income taxes, but we see it all the time. We have clients that are very involved with commercial real estate, and that's one of the benefits of it. You can add leverage to it, which means you're using borrowed money to buy it. So that $100 you can put in your stock portfolio, or you could take that $100 and put it into a real estate purchase and use $200 from us. We give you $200, you put $100 of your own money, and now you have $300 working for you instead of just $100 in a commercial property. On top of that, the income that comes off of that, you may not have to pay taxes on it if you structure it right, if you depreciate it right, if you have the interest expense. So there's all kind of ways, but as far as the outlook for commercial real estate, I think it's highly localized and highly specific to the kind of real estate it is. I don't see any more questions, Paul. So I'm going to stop sharing my screen and then turn it over to Eric to jump into trust basics.
Sounds good.
All righty, thanks, Dirk. Let's see if I can take this over from you. Let me know if you can see my screen.
We got it.
You're good.
Got it. All right. All right. Well, before we jump into it, as Dirk said, I'm Eric Baggett. I'm the wealth strategist here on the team at the private bank. But before I was here, I was in private practice for over a decade as an estate planning attorney. So having these types of discussions, drafting these types of documents for my clients, and it's that perspective and background of experience that I bring to my current role, and ultimately that perspective that I'll talk to you all tonight from. So I'll jump into it. First and foremost, why do we start with trust? We really start with trust basics because the trust is the core of any modern estate plan. Estate plan being a term that encompasses all the documents that are needed to govern your estate. And so really, what are those documents? Traditionally, we have a will, we have a trust, we have a durable power of attorney, we have an advanced healthcare directive, and you might have some other miscellaneous documents, but those documents are really the main documents. But while traditionally the will was the primary document of disposing of property at death, modernly that has gone by the wayside, primarily because if you dispose of property at death under a will, that will has to be supervised, administered by an attorney in the probate court, and the probate court is much like many of our courts, cumbersome, overworked, and a time-consuming and expensive process to navigate. And so, especially in California. So, in California, modernly, we've gone away from the will being the primary document, and now the trust is the primary estate planning document, and all the other documents I would refer to as the ancillary estate planning documents. So we'll talk about the trust tonight and the various types of trusts that are out there. But first and foremost, why establish a trust? As I just said, disposition of property at death is the primary reason, but there's also these other reasons, and that a trust can allow you to address incapacity in terms of who should govern your financial decisions if you, have some sort of medical condition, incident, accident, something that leaves you incapacitated. You name the person in the trust, the trustee, to govern the affairs of the trust when you are incapacitated. So that's one reason. Another reason would be asset protection. When you leave assets in trust for the benefit of another, those trust assets are protected from that beneficiary's creditors. They're also segregated from that beneficiary's spouse in the event of divorce. So there are some asset protection benefits of trust established for other people. Also, there's tax management. There are ways that you can leave assets to beneficiaries in a more tax efficient manner using trust than if you left those assets to them outright. And also trusts are private. They don't get recorded anywhere. It's internal affairs, assuming there's no lawsuits. No one other than the trust, the settlor, the trustee, and the beneficiary, is aware of what's in the trust or what's being distributed to whom. That's not the case with a will. Another reason why we don't use wills anymore. Wills are administered by the probate court. What's in probate court is a matter of public record. And so everything that goes to the probate court is basically available for inspection. That's why you may recall, like when Prince died, within a couple of days of his death, you knew entirely what his will said and how much his estate was worth and approximately and who was distributing what. James Gandolfini, another celebrity that died, same thing, didn't do his planning under a trust. And so now his estate is open to the world to see who gets what and how much. So anyways, a lot of our clients really appreciate the fact that in addition to avoiding the probate court, when they do their planning under a trust, it remains a private family matter. So how do you create a trust? Really? Well, it's pretty simple. You hire an attorney, you go through the steps of figuring out who you want to be in charge and who you want to leave assets to and in what form. And the attorney prepares the document and ultimately you sign, and there you have a trust. Many people, though, are under the impression that that's all you have to do. And unfortunately, I've had a lot of clients come into my office thinking that's all they had to do, but that's really only step one. Step two is funding the trust. You have to actually put assets in the trust in order for the trust to operate on it, either during lifetime or at death. And so step two is probably as critical as getting the trust drafted and signed, and that's transferring the assets into the trust, funding the trust. And that's as simple as changing title on financial accounts, or transferring real estate via deed, or transferring interest in companies like LLCs or LPs via an assignment or a share certificate or things of that sort. So anyways, that's really as crucial of a step as having the trust drafted in the first place. Once you have the trust funded, basically these terms here on this slide just define kind of the aspects of the trust. The trust principle is really just a term to define what's in the trust. Trust management just describes what the trustee does. And the trust term describes how long the trust lasts for. In California, there's a maximum term for how long a trust can last, meaning how long assets can be retained in trust before they have to be distributed outright to the beneficiary. That rule in California is basically what's called the rule against perpetuities, that says at the time that the trust becomes irrevocable, everyone who's alive at that time, when the last of those people are deceased, then the trust must terminate 21 years after the death of the last person who was alive when the trust was created. That's an old common law rule, and it's actually another movie reference. If you've seen the movie The Descendants with George Clooney, he's serving as trustee of a trust in Hawaii that is up against the rule against perpetuities clock, meaning it is a very old trust and it is about to have to terminate. And he has to decide what to do with the trust assets. So with old trust, this comes into play because it takes about 100 years for that time period to run. But it's still something to be aware of because there are jurisdictions outside of California where if you're looking to do trust planning, that can go on for generation to generation to generation. Some jurisdictions don't have those rules. And we have a lot of clients that do multi-generational planning in those jurisdictions. So I'll focus on kind of the key players in a trust structure. The first being, I already mentioned on the last page, the settlor. The settlor is the person who sets up the trust. Also sometimes referred to as the grantor or the trustor or the trust maker. No difference between any of those terms, really just synonyms that attorneys like to use to make things seem more complicated than they really are. They all mean the exact same thing. And so I typically use the term settlor, but in any event, it's just the person who sets up the trust. Secondly, we have the beneficiary. The beneficiary is the person or entity usually being a charity for whom the trust is created. And then within beneficiary, you have different types of beneficiaries that really just describe the type of interest they have. And so if you have a beneficiary that's a current beneficiary, it means they're a beneficiary that's entitled to receive current distributions from the trust. If they're a remainder beneficiary is a beneficiary who currently receives nothing, but at the death of the current beneficiary would then step in and become a current beneficiary at that time. So that's what a remainder beneficiary is. Also, you might have a distinction between within a current beneficiary, either an income beneficiary or a principal beneficiary. An income beneficiary would be one who is only entitled to receive income distributions. A principal beneficiary would be one that would be entitled to receive distributions of the trust principal, the trust corpus, not just the income that's being generated by the assets. And then in addition to distributions of either income or principal, you might have specific distributions that are authorized under the trust to the beneficiaries. The most common being what we call the ascertainable standard distribution for a beneficiary's health, education, maintenance, and support. Ascertainable because everyone knows what that means. And what I mean by that is that terminology has been scrutinized, litigated, and approved by the IRS, that they understand what that means and that there are no negative tax ramifications and if distributions are limited to an ascertainable standard. So that's the common standard you'll see in most documents. You also might see distributions to purchase a home, start a business, or at certain certain points or ages in a beneficiary's life. Excuse me. Finally, the third key player in the trust structure is the trustee. The trustee is really the person or the entity. You would either name an individual most time in a trust document, or you might name a corporate trustee like Bank of America, or you might name an individual professional fiduciary, which is an individual, but one that is in the business of trust administration. And they're basically responsible for managing the trust. They need to know what the terms are. They have legal responsibility. They are a fiduciary, meaning they have to act in the best interests of the beneficiaries in administering the trust. And if they don't act in the best interest, they can be sued and held legally liable for either a breach of trust or a breach of their fiduciary duties. It's a lot that goes along with serving as trustee. They have to control and protect the assets, keep them with, protected institutions, carry the right amount of insurance, make sure that they're accounting for the assets and letting the beneficiaries know on a semi-regular basis what the assets of the trust are doing in terms of income, growth, how they're being managed. They have to choose the investment advisor, manage those investments, manage the tax issues related to the trust, make sure that the taxes are being filed, tax returns filed, taxes paid. Generally, it is a full professional obligation that oftentimes, especially as the numbers get larger, require professional advisors to really best carry out the duties. So I'll shift gears here a little bit and talk about the types of trusts. So when I talked earlier about the core of every estate plan being a trust, really what I mean is the revocable living trust, and that's the first category here. The revocable living trust is the trust that you set up during your lifetime, mainly designed to dispose of your property at death, name beneficiaries, name the trustees, fund with your assets that you currently own, and provide for the orderly distribution of your assets at your death. That's where the revocable living trust comes in. Also, typically can be referred to as a revocable trust, an inter vivos trust, if your attorney likes to use Latin. Again, complete synonyms there, no distinction between that. And then the other types of trusts you have are irrevocable trusts. These are trusts that the settlor typically set up during lifetime. And the primary motivation usually to funding an irrevocable trust is tax savings. The idea being that if you're a client that has net worth in excess of the current estate tax exemption, then you're going to have a taxable estate at your death. And if you can transfer those assets out of your estate during your lifetime, you're likely to minimize or eliminate that estate tax due at death. And so that's where irrevocable trusts come in play. Individuals who typically have more than enough to live on for their remaining lifetimes will start doing tax planning in the form of setting up irrevocable trusts to start transferring assets typically to the next generation during their lifetime. So that way their taxable estate will be reduced and they'll ideally pay less estate tax at their death. Within irrevocable trusts, you have quite the variety of different trusts. They're all designed to do the same thing, get assets from the senior generation to the junior generation in a tax efficient manner, but they come in a wide variety of shapes and sizes. Some of those might be generation skipping or dynasty trusts. Those typically refer to trusts like I described that are intended to go on for generation to generation. And so you might see those set up in a jurisdiction that does not have that rule against perpetuities that limits the maximum duration of trust. Irrevocable life insurance trust. This is a trust set up specifically to hold life insurance, but it holds the asset outside of the settlor's estate. So that way the life insurance proceeds won't be included in the settlor's estate for estate tax purposes. Grantor retained annuity trust, just another trust, complexity there, but ultimately designed to move assets down to the next generation in a tax efficient manner. Qualified personal residence trust, same idea there, just it holds a personal residence as the asset that's being transferred to the next generation. All of these occur while the settlor is still alive, sets these up, makes lifetime transfers to these types of trusts for tax reasons. So generally, while I'm sure many of you have done your own estate planning, set up your own revocable living trust, oftentimes that document gets contemplated, signed, funded, and then stuck in a drawer and not really thought about for many years down the road. And oftentimes we find that clients' first real interaction with the administration of a trust comes when they're actually a beneficiary, either of a grandparent's or a parent's trust. And that's really where they can see the complexity of administration and also understand the responsibility of the trustee and the beneficiaries. So if you find yourself as a beneficiary, you really have to, the trustee will be represented by attorney, helping them carry out their duties as a trustee, but the beneficiaries often aren't. And so if you find yourself that your first interaction with the trust is as a beneficiary, it's really on you to read the trust, understand the structure, take it to an attorney if you feel you need help with interpretation or that administration by the trustee is not being done in a timely manner or not being done according to the document. Learn about your rights if you're a beneficiary in terms of what you have in terms of income distributions, principal distributions. Do they happen automatically? Do you have to request them? Sometimes there's a process to go before you can receive a distribution. Also, sometimes trusts, even though they're distributed, they're left in trust, sometimes they distribute at ages. And if you're already of the age required to receive a distribution, you might actually just get the entire trust principal outright because you've reached that age. Also, it's always good if you're a beneficiary to understand how the assets in the trust are being managed. The trustee is probably not the investment manager unless you're using a corporate trustee. And so, asked to speak with an investment manager, asked to, scrutinize the investments just like you would your own. Because in a sense, when the trustee manages them for the benefit of the beneficiary, they really are the beneficiary's assets because that's who they ultimately go to benefit. Also, some trusts allow for a beneficiary to serve as sole or co-trustee, which is helpful if you're already of the age that would be permitted under the document. You might want to consider either naming yourself a co-trustee if you have that power to serve alongside, or if you feel that you could handle the administration on your own, serve as your own trustee. So those are just kind of some issues typically facing beneficiaries after a trust is first set up. One thing you also might have as a beneficiary is a power of appointment. And really it means assets are left to you in trust, subject to the terms of the trust. But sometimes there might be powers where either during your lifetime or at your death, you can direct some of those trust assets to other individuals in the manner that you see fit. So you can essentially change the terms of the trust in effect as it relates to other individuals. So rather than assets simply passing to your descendants at your death, if there's still assets in the trust, you might be able to direct that those assets, pass to trust for the benefit of your descendants that you've set up with the terms that you would choose to govern the trust for those beneficiaries. Or if you have descendants that don't need assets that are in your trust because they already have large estates on their own, you might direct all of the trust to one descendant or another. So powers of appointment just allow you as the beneficiary to have some control over the ultimate disposition of those of the assets that are in your trust. And so knowing whether you have those and when they become effective is often a useful tool. So I have some questions. So I'll go to the questions here before I go on to the next section. It says, first, did I understand there's still a need for a will even though you have a trust? Is that true? And if so, why? Yes, even though the trust is the core of the estate planning documents, yes, you still have a will. But what the will is rather than dispose of all the property, it will contain a pour over provision, and it's commonly referred to as a pour over will, where basically all the will will say is, hey, I've already set up this revocable living trust. I should have transferred all the assets to that trust during my lifetime. If I didn't, though, transfer assets to that trust during my lifetime, and they remain in my individual name at my death, then at my death, transfer those assets to my trust. So they won't contain any other dispositive provisions other than that. It's simply a pour over will that pours any assets held in the individual name into the trust at death. All right.
So if I've got, Eric, I've got $50,000 in the bank and my checking account wasn't part of the trust, you would move something like that.
That's right. That's right. There are some other non-probate tools when you have small assets. So under $150,000, you don't have to go full probate. You'd have to provide a copy of the will. But yes, exactly. They would look to the will. If it was over $150,000 in a financial account, then yes, you'd have to go you take the will to the probate court. The probate court would read it, interpret it, and say, yes, distribute that account to the trust because that's what the will says.
Perfect.
All right, next question. Do you need to update a trust? How often should you update? I would say review your trust every 3 to 5 years. Sometimes no updates are necessary. Oftentimes they are. Typically what you're looking for is, have you had more children? That's often a time. You want to make sure that they're adequately accounted for in the document, named in the document. Has anyone died that you were leaving assets to since the last time you prepared your document? That can sometimes be the case. Do your trustees make sense? Oftentimes the trustees you might name when you're young or when your children are young might be individuals, where as you get older, accumulate more net worth, no longer have young children, you might opt more for a professional trustee or a corporate trustee. So you're looking, and then fourth, do the assets in terms of how they're being distributed still reflect your intent in terms of how you would want them to go out? So I'd say you're looking at your trust, anything, there's a change in one of those things in your life, then you should be looking at your trust as soon as that change occurs. But even without one of those changes, look every 3 to 5 years, review it, keep those potential changes in mind, and determine whether all of those things still make sense given how your life has changed in the last 3 and 5 years. Let's see. And then how often should you update and what is the cost? So you don't need to update. I have clients that go, 10 years. If they establish the trust, typically once they were done having kids and maybe those kids are still in high school, you could go 10 years from ages, 8 to 18, where you didn't really need to change anything and everything makes sense. After that point, when you have adult children, then you're typically making changes more frequently. Also at that point, you might have trustee changes more frequently as the people you would name are likely getting older. So that's I'd say it will be more frequent as you get older. And then what's the cost to update? The cost to update, it depends on how significant of an update it is. If it's just something that you're changing a trustee, or you're changing adding a reference to a child, things like that, those are fairly inexpensive, because they can usually be handled by way of an amendment, which is just a 1 or 2 page document that changes a few terms. If you're changing the entire structure, going a different direction entirely in terms of how assets should be distributed, then you'd be looking at a restatement of the trust, which is essentially a complete redo of the whole trust. So amendments, I'd say, typically run, $1,000 to $2,000 in hourly fees at a reputable attorney. A complete restatement is probably somewhere in the $4,000 to $6,000 range to completely redo the trust, because you're basically going through the whole process again, other than the fact that the trust is already funded. And then what type of income or net worth would a person have where an irrevocable trust would be recommended in order to reduce taxes? Really, it corresponds to the estate tax exemption. So right now, the estate tax exemption, the amount that anyone can die with before estate tax is incurred, is at all-time highs, at $12.06 million worth of assets. So if you don't have that level of net worth at death, then you don't need to transfer assets during your lifetime to avoid the estate tax. Problem is that estate tax exemption is a moving target. It's at all-time highs, but in the early 2000s, it was $1 million. Then it inched up to 2 million, and then 3.5 million. And then 2010, it went to 5 million. And then it's been inflation indexed. And then it was doubled by the 2017 Tax Act. That's how we ended up at 12.06. And at the end of 2025, under current law, it goes back down to $5 million inflation index, which will put us somewhere between $6 million and $7 million worth of estate tax exemption. So it's still a high number. So you don't necessarily have to do planning if you're below that threshold, but just recognizing that that threshold has been much lower historically. And if you're close to the threshold, you want to look at your entire estate. First and foremost, determine that you have enough to live the way you want to live before you start giving away assets. I never like clients to give away assets for tax purposes and then feel poor afterwards. So, making sure you're comfortable with those strategies, and if you're over the estate tax exemption and comfortable with giving away some assets, then start looking at irrevocable trusts and lifetime transfers to those irrevocable trusts.
Before you move on, I have a hand raised, so we're going to try to see Reno if you're there and you want to unmute yourself. So let's see if we can do a live question. There we go.
All right.
Thank you.
You're up, Reno.
Oh, no, I'm fine. I'm just digesting everything about trust. Thank you very much, Attorney Eric.
Okay. That's all right. Well, at least we know that system works. So if anyone does want to
exactly,
we can do that on the fly. So
I do have one question.
Oh, go ahead.
I guess the trust attorney registers the trust, or does it even have to be registered with the government?
Nope, it's not registered. So nothing gets filed, nothing gets recorded. It's a private document. So the only time it gets disclosed in litigation, if there was litigation over a trust, then ultimately, if there's a court case and it gets filed in the records of the court, then it becomes public record. If you have a taxable estate and an estate tax return gets filed, then it ultimately gets attached to the estate tax return. So the IRS then gets to review a copy of it, but that does not become a matter of public record. No one can request that. But in most cases, no one sees it but the settlor, the trustee, and the beneficiaries.
Thank you.
Sure.
I'll mute myself again because my dog does some barking sometimes.
All right, no problem. Thanks. All right, I'll move on to income taxes since we only have about 15 minutes here. And I'll try to get through this pretty quick since you are all probably familiar with income taxes and that we all pay it. I'm pretty sure you probably all understand the reason for it. It is the primary funding mechanism for our government is our income tax system. The IRS collects the dollars and ultimately distributes it out via the budget. We have a progressive tax system where people who make more money pay higher tax rates. However, even if you're in a high tax bracket, there may be things you are able to do to reduce your income taxes through some strategic tax planning, which is what we help our clients do. So what are some of those ways? Generally speaking, they fall into kind of 3 tax categories. There are some strategies that you can do that entirely eliminate income tax. Some examples of those mean investments in certain assets are tax-free, like tax-free municipal bonds. The income generated by those bonds is tax-free. Also, a Roth IRA, if you contributed to a Roth IRA, distributions made out of a Roth after age 59 and a half come out income tax-free. So in those situations, tax is entirely eliminated. Other strategies involve just deferring the payment of tax. So that's your typical employer-sponsored retirement plans would be one example. So a 401k or an IRA. Or, for example, what Dirk was talking about earlier, investing in assets for capital appreciation that only incur capital gains tax when the asset is sold. In a sense, you're getting the benefit of the appreciation of the asset, but you might not be paying the tax until it is sold many years down the road, where if you invest in something that either throws off interest or throws off a dividend each year, you're going to be paying the income tax liability associated with that each year as it is earned. And so deferral often comes into place when we think about tax planning, and then just reducing your overall tax liability by investing in things that have preferential tax treatment. For example, capital gains, long-term capital gains are taxed at a lower rate than ordinary income. So interest, rents, royalties, they're subject to the same ordinary income tax rates that compensation is, where long-term capital gains are subject to a lower tax rate. And so that's one strategy, is to tailor your investing to result in more capital gain income rather than ordinary income. You can also use debt to generate interest expense that is deductible. There's a variety of ways, and then I'll talk about deductions here in a second. But before we get into kind of each category here, this is really just a general depiction of how we arrive at what any individual's income tax is. We start with total income, which includes income from all sources. So salary, interest, dividends, capital gains, business income, trust income if they're a beneficiary of a trust receiving distributions, rental income if they own rental property, retirement plan if they're taking distributions from an IRA or a 401k, alimony if they're divorced and entitled to alimony. So anyways, most clients don't have all of these categories, but usually have a few. If you're employed by a large healthcare institution, you probably receive the majority of your income by way of salary compensation. If you own your own practice, probably you might pay yourself some form of salary, but the rest of your income may come in the form of a distribution from whatever entity you have set up through which your business is run through. So that's where we start. Then we take the above the line deductions. This typically are the deductions that everyone is entitled to. They're usually the deductions that come straight out of your paycheck. So contributions to your retirement plan, 401k, your medical insurance that gets deducted straight from your account. If you have a health savings account, if you have commuting expenses, all of those are referred to as above the line deductions, because essentially everyone qualifies for them. Once you subtract that out, we arrive at a number called adjusted gross income. And your amount of adjusted gross income determines the extent to which you receive the below the line deductions. This is just another set of deductions that the IRS has determined are not as important as the above the line deductions, so they don't apply to everyone. You can typically either take the standard deduction, which means the IRS just assumes you have a certain base level of below the line deductions and let you just take a fixed number without any evidence that you meet those deductions, or you can itemize, which means you show the various deductions you're entitled to that in turn also will lower your taxable income. So we arrive at taxable income, and that's the amount that your tax is calculated on. I'll go into each of these categories in a little more detail now. So what's total income include? I went through this: compensation, investment, trust, business, rent, royalties, retirement plans. But there are exceptions. So not everything you receive is income. So if you receive a gift, someone gives you a gift, parents, grandparents, really nice friends, in any event, any gift to you is not income. You don't have to report that as income on your income tax return. Likewise, if you inherit property under a trust or directly via distribution from a trust, that is not income to you. So that doesn't get reported. I said earlier, most municipal bond interest, income tax free. It actually doesn't count as income. Gain from the sale of your residence. If you sell a personal residence, I'll talk about this a little bit more later. There's a exclusion that excludes the first $250,000 in gain from taxable income. Also, as I said earlier, distribution from Roth IRAs, distributions from 529 savings plans. These are plans set up for educational expenses. If you take a distribution to pay educational expenses, then that distribution is not income to you. Also, certain insurance proceeds, typically life insurance proceeds, when those are paid out upon the death of the insured, it's not income to the recipient. So the deductions I went through earlier, this is typically this category of deductions is referring to the below the line deductions. So the ones that you may or may not be fully entitled to. Often they refer charitable contributions are limited to a percentage of your AGI. Mortgage interest is typically fully deductible. Medical expenses are deductible above a certain threshold of AGI. Real estate taxes expenses are deductible. However, they've been subject to a cap for the last few years. In any event, they help reduce excuse me. I'm sorry.
All right, take your time. While he's doing that, Dirk, do you want to expand on the Roth IRA? I saw your typed answer. Should I have a backdoor Roth conversion?
Sorry. Yes. So the question was, could you contribute to, or if you're over the income limits, how would they contribute to a Roth IRA? And you still can what we call a backdoor Roth. You may have heard it called a backdoor Roth, which is you contribute to a traditional IRA with a non-deductible contribution to the traditional IRA, and then convert that to a Roth IRA. So there's no income limits for the conversion of a traditional IRA to a Roth IRA. So you can get those assets into the Roth via conversion versus directly into the traditional.
All right, sorry about that. Let me see. Ran out of water here, and now my throat's tightening up on me. Anyways, above the all right, so the standard deduction, I talked about this earlier. This is the amount that you can just take automatically. $12,950 for a single person, $25,900 for married, and then you don't have to itemize. I apologize. I'm losing my voice here. Too much talking, I guess, at one go.
We're a healthcare group. Don't hurt yourself.
You know how it goes here. So these amounts reduce your AGI and therefore your taxable income. If you itemize, then you'll be looking at basically having to document your various itemized deductions. So as I said before, medical expenses that exceed 10% of AGI, taxes, that's state and real estate taxes, and then interest expense. So basically, and then charitable contributions limited to an AGI limit. Typically, if you own a home in California, you're probably going to be itemizing deductions because you're going to have significant real estate taxes, and then you likely have significant interest expense. And so for most people, that will exceed the standard deduction when you own real estate just by itself when you own real estate in California. Home mortgage interest, though, it's limited to the first $750,000 of indebtedness on a primary resident. So if you have a debt that exceeds that, you won't get to deduct any interest attributable to the excess over $750,000. And then points are also included, considered prepaid interest. So, so you get a deduction related to that. Once you have your taxable income, your ordinary income, so all your compensation, your earnings, your rents, interest, royalties, they are taxed at ordinary income tax rates. And this is the bracket here. You can see it starts at 10%, quickly moves up to 24%, then 32, 35, 37 when you're a single person making more than 539,000. So important to note, though, it's a blended rate. You get to ride the bracket up. So just because you make over, say, 539,000, it doesn't mean all your dollars are going to be taxed at that top rate. You're going to be taxed at a corresponding rate as you move up the bracket. And so typically, if you're in this top bracket, your blended rate is really going to be somewhere in the neighborhood, somewhere less than 37%, because the dollars below 539,000 were taxed at a lower rate of some amount. Also, this doesn't apply to long-term capital gains or dividends. As I said earlier, they are entitled to a preferred rate, and that is usually, depending on what bracket you're in, that will either be 15% on long-term capital gains and capital gains rate. Typically, if you're a single person with taxable income, I think it's below 459,000, and then over that amount, if your taxable income, then your long-term capital gains rate is 20%. So still better than the ordinary income tax rate that would apply. Often preferred to if you have to pay tax, pay it in the form of long-term capital gain than ordinary income. Alternative minimum tax, I won't say much about, but this was put into place because wealthy individuals got really good at maximizing their itemized deduction, and the IRS decided that they were lowering their taxable income too much. And so basically, if you're a high income earner and you have a lot of deductions, the IRS will also look at your taxable income through the AMT lens, the alternative minimum tax lens, which basically subtracts out a bunch of your deductions and imposes a different tax rate. And if the AMT tax rate would result in higher tax than the standard tax rate, then you'll end up paying the higher of either the AMT or the standard tax rate. So it really only affects people who are high income earners who have a lot of deductions. Capital gains and losses, as I said earlier, this is from the sale of a capital asset. All I'll say, you got to be in the long-term rate to get the preferred rate. Long-term means you've held the asset for more than a year. Short-term means you've held it for less than a year. And then the gain on the sale of your home. As I said before, this was excluded from income up to the first $250,000 of gain when it's your primary residence. $500,000 if you're a married couple filing jointly. So you can exclude that amount of gain when you sell. It's not income to you, so you don't have to pay tax when you only have gain up to that amount. Any gain in excess of that amount would be subject to normal long-term capital gains rate. Paying your income taxes done by your 1040. Typically, if you're a W-2 employee and you receive mostly compensation, your taxes are primarily paid through your paycheck withholdings. You're really just filing your taxes to see how close you're filing your return because you're required to, but really in terms of taxes, you're either just filing to see how close your withholding was, and you should either get a small refund or make a small payment based on how close you are in estimating what should be withheld from your paycheck. If you own your own practice, then you probably make estimated tax payments that do the same thing. You're trying to guess how much tax you're going to owe next year. Hopefully you get pretty close, and then you either have to make a small tax payment when you file your taxes or get a small refund.
Anything else? Final words, Dirk or Eric?
Nothing. Thanks for having us, Paul. Thanks for the opportunity to talk about this stuff. You probably can tell Eric and I enjoy doing this, and happy to answer questions. If we didn't answer them live, our contact information is in the slides. You can feel free to reach out to us anytime. Happy to help.
Yeah, and if anybody has follow-up questions directly or is interested in the video or the slides, please email sdcms@sdcms.org. And staff, once we get that downloaded, we'll make that accessible to you. Again, Bank of America Private Bank have been our partners for a number of years now. They handle the medical society's reserves and investments directly. They're part of our fiduciary team here at the Medical Society, and so we've had a very good relationship with them and appreciate their help with members in all sorts of ways. I know some have reached out and done mortgage assistance and refinancing their homes or home purchases through the assets that BAMA has. Investment advice, there's the opportunity to do investment support for expanding or growing your businesses and the like. So with that, I want to thank everybody and say good night.